Hello and welcome to the Life by Design podcast, brought to you by Strategic. This podcast is all about helping you live your great life. Hello and welcome back to the Life by Design podcast. This week we're doing something a little bit special. Quarterly, we will be doing our quarterly perspectives. Doug, our CIO here, he does a blog post every quarter, kind of wrapping up what we saw and maybe looking forward a little bit to the next quarter.
Exactly.
And so we thought it would be a good idea to dedicate one podcast every quarter to that. And here we are. So very excited to have Doug on for the full podcast today.
Oh, it's exciting.
So the first thing we're going to look at, Doug, is kind of looking at Q1 of 2025 and dissecting a little bit what we saw, what was going on. Yeah. And I know one of the first topics you wanted to cover was the inflation and the Fed and all the conversation around that.
Right. And regular readers of Perspectives will note that we talk about inflation in the Fed every single time with a slight variation of the chart because it is incredibly important, right? Yep. The Fed has been playing this balancing act, trying to get to the point where it can reduce rates to a point that it feels is the right level, but it needs to see inflation come down. And that's been the challenge. It had come down quite a bit from where we were in the COVID days, but it's kind of getting stuck in this high twos range. And the Fed wants to see it around 2%. So when we think about this quarter, like what did we see in January? We actually saw a pretty significant decline in inflation, and the market celebrated that. Unfortunately, inflation for February went back up. And so there was a bit of concern about that. And so the Fed, seeing that data and also knowing the sort of threat of tariffs coming down the road, basically left rates on hold. And not only did that, left its expectations for future rate cuts on hold.
And so with a lot of that looking, there were some expectations, these lofty expectations, I guess, for mega caps that we were looking at as well.
Yeah. So there was a lot of expectations built in, hoping that the Fed would be getting to that point. It can, continue to reduce rates. That's generally good for stocks. What we saw is, again, this sort of disappointing inflation picture play out. That hit equities. It hit U.S. equities particularly hard, and it hit U.S. mega caps extremely hard. So if you think about the 7 mega caps we tend to focus on, being Amazon, Apple, Microsoft, Tesla, etc., Nvidia, those stocks were down in aggregate together 16.4%. So to put that in perspective, the S&P 500 was down 4.3%. So these big stocks that have been leading the market for several years now were a big drag on the market. And when you do a little bit of math on that and figure out what the other 493 stocks in the S&P 500 are doing, on average, they were actually up. So they were up 2.5%, but the overall index being dragged down by those mega caps.
And so a lot of that weakness came in the uncertainty about what the tariffs were going to do, correct?
Right. And it's not just tariffs. It's really the implication of tariffs. Tariffs have, on average, a tendency to slow down economic growth. And they also have a tendency to raise prices. So again, that's fighting against what the Fed is trying to do, right? To get to a point where inflation is down to 2%. And sort of the worst case scenario for investors is when you get to no growth or negative growth and rising inflation. That's called stagflation. And so not to say that we're expecting stagflation to come to fruition, but you started to hear the term thrown around in the first quarter, and that's a big negative for equities, in particular equities that had a lot of good news priced in, being those mega cap stocks.
Okay. And though we saw some decline in the U.S. stocks and those mega caps, it wasn't exactly matched in overseas.
Right. So the saving grace for a well-diversified portfolio was that international stocks actually did quite well. So if you look at developed international, they were up on average 7%. and we did have a position in our strategies in developed international value stocks, and that was up about 13%. So international doing significantly better than the U.S., and even emerging markets was up, I think, 3 or 4%. So some of that, especially in the developed markets, was currency. So the U.S. dollar weakened. You think about who we are. We are living here in the U.S. We are investing in dollars. So if the dollar weakens, by definition, you're going to get an extra. That's going to be reflected positively in your international holdings because their currencies are strengthening relative to the dollar. So about 4% of that 7% positive performance was purely just currency.
Oh, that's really interesting. And so also the recent high correlation between stocks and bonds started to break down a little bit too.
Right. So yeah, sticking on that theme of diversification, bonds held up in value. In fact, they increased in the quarter during this weakness in stocks. And what's interesting about that sounds, it's pretty much sort of textbook behavior for bonds, what you expected to do, and that's why you have them in there for diversification. But we haven't seen that in recent years. And there's been a lot of, questions about, bonds use as a diversifier. So I think back to 2022, that was a down year for equities, and bonds were down quite a bit that year. So they didn't play that stabilizing role that they normally do in a portfolio. In the subsequent 2 years, so 2023 and 2024, we saw stocks up. Bonds were also up, so they were positively correlated, but people don't care about lack of correlation when everything's going up, right?
Yeah.
So that was fine. But this year, in the first quarter, during this stock weakness, we've actually had bonds hold up well. So they've been playing that diversifying role that you hope they play, and giving you a lever to rebalance into holding up in value. So if you rebalance, you can sell those bonds at a higher price and buy those cheaper equities.
And this is taking on like a more traditional role.
Exactly. That's what you would expect. Sort of textbook behavior of stocks and bonds is that they move in opposite directions. Particularly when the stock market is weak, you would hope that your bonds are strong.
Okay. And speaking of diversification, gold continues to be a preferred asset in uncertain markets.
Yeah. So we haven't talked about gold yet, which is amazing because it was up 19% in the first quarter.
Yeah.
And so we do generally have gold in our strategies as a diversifier. It was really, I think, playing two roles this quarter. One is it is normally thought of as an inflation hedge. And so if you're concerned about inflation, which certainly market participants were, then it's going to do well. But it's also just generally seen as a safe haven or a place to sort of flee if you're in times of uncertainty. It's a little bit odd because gold, it is actually a volatile asset. So to think of it, it's sort of odd to think of it as a safe haven, but that's how it does tend to behave when there's nerves in the market. People are getting nervous about stocks. They tend to flee to things like gold. We also saw, speaking of inflation tips, Treasury inflation protected securities were up on the quarter. So again, an inflation hedge, again, a good part of a well-diversified portfolio.
Okay. And so as we go into our next section here, you had a quote on the quarterly perspectives from Warren Buffett that said, "Be fearful when others are greedy, and greedy when others are fearful."
Right.
And so with that, I'll move into our Q2 playbook for 2025 and kind of what we're looking at here in Strategic and some things that maybe folks at home want to be aware of as well.
Right. Yeah, sounds good.
So what we're looking at is coming into April. We had our April 5th announcement, and as we look forward, what are we looking at from our perspective there?
Yeah. I think I'll start with April 5th, and those tariff announcements were bigger and broader than the market had expected, and the reaction in stocks was basically to decline. So stocks, as we're talking today, U.S. stocks are down around 18% from their peak. This is going back, before April 5th, but they're well off their peak. And so again, that theme, that concern that was in the first quarter about the potential for inflation and slowing growth, just really got exasperated by those tariff announcements, which, taken at face value, would be a drag on growth and an increase in prices over time.
Mm-hmm. And though we're uncertain because we don't have a crystal ball of what's happening next, our CEO in a recent video that we've sent out to our clients had said, for whatever powers may be that are in charge, right, their whole goal is to get reelected. And so one of the things we would look to is that they're going to do something about that if it continues to trend this way, potentially.
Yeah, it's quite possible, right? We don't have the crystal ball, but it would not be an illogical conclusion that politicians want to get reelected, and if they feel like the sentiment is moving against them, that they might do things to change that. I would just say, there's really three potential actions that could happen here, or things that could happen. You could have the current administration hold steady, right? This is our policy and we're sticking to it. We could move into a scenario of negotiation, right? Hey, this was our starting point for negotiations and we're going to find ourselves in a better place down the road. Or they could just 100% capitulate and say, this isn't working, or we're not going to get elected, so let's change our paths. And I think that really just reflects the nature of the uncertainty that we're currently facing.
Mm-hmm.
And to try to predict that is probably a futile task and is not really the direction you'd want to go in terms of the game plan for the quarter ahead and the year ahead.
Yeah, and for the listeners who have been with us, I was going to say from the beginning, but it's 5 episodes. We're on episode 5. But for the last few weeks, and something we've talked about a lot is, though the news is hot with all these topics and talking about this, a lot of stuff, movements happening in the stock market, a lot of news items are out there. One of the things that we really talk about here is not letting your emotions play into that and start feeding your fears.
Right. Yeah, it's a great point, and one that is worth reiterating. So I know Greg talked about it a few weeks ago. I've talked about it, but this idea of action bias. These emotions that we feel lead to a desire to take action, right? It is hard to see your portfolio fall in value and just sit and watch it, right? And not take any action. You feel like you must do something, but often it is the worst thing you can do.
Yeah.
And I personally love the story of the goalie. I know we've said it before, but it's such a cool analogy. The professional goalies, again, great study done, said that the best thing for a goalie to do when facing a penalty kick is to stand in the middle of the goal and basically react from that position. But if you ever watch professional soccer, they're almost always diving, right? They're diving to one side or the other. And it comes down to this idea of action bias. Like, it is much harder to stand in the middle and watch that ball, hit the corner of the net and sort of look foolish, right? Even though you did what was logically the right thing to do, the crowd probably doesn't see it that way. You certainly don't feel that way. Now you feel foolish. Had you dove even in the wrong direction, at least you feel like I took some action.
Yeah.
Right? I took some action. So our job here is not to take action for the sake of action, but to take action that is guided by evidence, that is not driven by emotion. And these times in particular, it is so important to heed that advice.
Yeah, and I think really when we set the emotions aside and you have a financial planner and you have someone that's looking out for you, that can separate the emotions a little bit, there's opportunities that can be found. And so some of the opportunities that we're seeing and taking advantage of right now.
Yeah. Declining markets do present opportunities. And so we are not standing still in the middle of the goal necessarily. We are taking action, and sort of some of the things we are doing is we are tax loss harvesting. So, when you have losses in a portfolio, you can, what we say, harvest them, basically sell those positions, lock in those capital losses, which you can offset against your gains. So it is a way to reduce your current tax bill. And so we certainly want to make sure we're doing that. Another use of that, maybe less frequently spoken about, but not just, you may not, another thing you can do with those losses is get your portfolio where you want it to be. So if you've been restricted in your ability to take gains, maybe your portfolio has drifted a little bit away from the targets. So if you take these losses, it gives you some losses to offset gains you may want to take to get your portfolio back on target. So we'll do both of those depending on the situation, either get you back on the target or just give you an opportunity to reduce this year's tax bill.
Yeah, and I think some of it, also some of the opportunities is rebalancing. Right.
And that is something we are looking at every week, every security, every portfolio. Are there opportunities to rebalance something that, basically selling high and buying low? So if we look at the rebalances of the last few weeks, you can probably predict what we've been selling. We've been selling gold, which is at an all-time high, and we've been putting that into equities that are a heck of a lot more cheaper than they were a couple of weeks ago. So that systematic rebalancing is going to take advantage of those market moves in a way that over time, again, evidence-based, has shown to add tens of basis points to performance in a portfolio.
Yeah, and really taking the opportunity to pick up some bargains if that sell-off continues, and taking a look at what's happening.
Right. Yeah. So the next step beyond rebalancing is, do we need to change tactically? Right. Has the market fallen so far that there's a real valuation opportunity here? And I would sort of caution on that narrative a little bit with U.S. equities. It does seem like they've fallen quite a bit, but they also have been trending higher for the last several years. So we entered this period with them on the expensive side. Some of that has been corrected. I wouldn't necessarily say that U.S. equities are cheap right now, but we are certainly watching for that scenario.
And then kind of talking about this overall, though maybe some of the news items and things that are happening are unique, this isn't, from a market perspective, a unique situation. We've been here before.
Yeah, we've been here many times, and probably more frequently than our listeners might imagine. So 2022, the market was down 23-24% or so. So that is a bigger decline than what we've experienced so far this time. 2020, obviously, COVID, big declines during that period. And even 2018, there were significant double-digit declines in the market. So 3 times in the last 7 years, we saw declines similar or more than what we're experiencing right now. And if you look over that period, it's a great time to be an equity owner. So if you're willing to stomach that volatility and stick with the market, it has paid off.
Yeah, and I think, again, reiterate, I think we're probably going to do this on every podcast forever. We don't have a crystal ball.
Right.
But we're going to do what we can in these moments to hopefully be opportunistic.
Right. Yeah, exactly. The worst thing you can do is react out of emotion. The best thing you can do is follow the evidence, see where the opportunities are, and take advantage of them. And that really gets back to that quote that you mentioned at the beginning, which is being greedy when others are fearful and fearful when others are greedy. Right now, we're at a point where the investors appear to be entering that fearful stage. So I'm not saying it's necessarily time to be greedy, but that's certainly the direction we'd be focusing.
Yeah, but those doors could open, and we'll be ready to walk through them when they do.
Right, exactly.
Yes. All right. Well, thank you, Doug, and thanks everyone for listening. And once again, you can expect these quarterly perspectives roughly at the end of every quarter. We'll be doing them. So thanks again, Doug.
All right. Thanks, Jay.
This podcast is for educational and informational purposes only. Please see the full disclosure in our show notes for more information.